Hello and welcome to the LP Financial Services Forex Training Class, Introduction to Fundamental Analysis videos. In Lesson 1, we'll talk about the determining factors affecting foreign exchange price movements. The world's currency markets can be considered as a massive melting pot. In a big and changing mix of current events, supply and demand ingredients are constantly switching, and the cost of one currency in relation to a second shifts accordingly. No additional marketplace comprehends as much of what is proceeding in the community at any given time as the foreign currency exchange. Supply and demand for any given currency, and thus its value, are not influenced by any single element, but rather by several. These elements generally fall into three categories: economic factors, political conditions, and market psychology. When we look at the economic factors, we see that these include economic policy, disseminated by government agencies and central banks, and economic conditions, generally revealed through economic reports. Economic policy is reflected by government fiscal policy, such as budget and spending practices. Monetary policy, which is the means by which government central banks influence the supply and cost of money, is reflected by the level of interest rates. Typically, a currency will lose value if there is a high level of inflation in the country, or if inflation levels are perceived to be rising. This is because inflation erodes purchasing power, thus demand for that particular currency. Reports such as gross domestic product, employment levels, retail sales, capital utilization, and others detail the levels of a country's economic growth and health. Generally, the more healthy and robust a country's economy, the better its currency will perform, and the more demand for it there will be. While economic numbers can certainly reflect economic policy, some reports may have an immediate impact on short-term market moves. What to watch for can change over time, with money supply, employment, trade balance figures, inflation numbers all taking turns in the spotlight. The market usually reacts negatively to widening government budget deficits and positively to narrowing budget deficits. The impact is reflected in the value of a country's currency. The trade flow between countries illustrates the demand for goods and services, which in turn indicates demand for a country's currency to conduct trade. Surpluses and deficits in trade of goods and services reflect the competitiveness of a nation's economy. For example, trade deficits may have a negative impact on a nation's currency. When we look at the political factors affecting the foreign exchange movements, we see that internal, regional, and international political conditions and cases have a profound effect on the currency marketplace. For instance, political upheaval and instability can have a negative impact on a nation's economy. The rise of a political faction that is perceived to be fiscally responsible can also have the opposite effect. Furthermore, political factors in one country of a region may spur positive or negative interest in a neighboring country and in the process affect its currency. Unsettling international events that can lead to a flight to quality, with investors seeking a safe haven. There will be a greater demand, thus a higher cost for currencies perceived as stronger over the relatively weaker counterparts. And perhaps the most difficult to find, as there are no balance sheets or income statements to decipher, is market psychology. Market psychology is the sum total influence of the human psyche on the process of making an investment or trading decision. The psychology of the markets exert influence on the foreign exchange trader in a variety of unique ways. Buy the rumor, sell the fact trading, and overall flights to quality also help contribute to the price movements of the foreign exchange market. This concludes Lesson 1, the determining of factors affecting foreign exchange price movements. In our next video, Lesson 2, we'll go over the concepts of fundamental analysis.